Hey everyone! Welcome back to the channel. If you're new here, I'm Govi, and today we're breaking down one of the most underrated ways to build wealth in the stock market, REITs, or real estate investment trusts. If you've ever wanted to invest in real estate but didn't have enough money to buy a property, or didn't want the headaches of fixing toilets at 3 a.m., this video is for you. By the end of this video, you'll understand what REITs are, how they make money, the different types, their risks and rewards, and how beginners can start investing today. Make sure to hit that like button, subscribe, and let's jump right in. Section 1. What exactly are REITs? Let's start with the basics. What is a REIT? A REIT is a company that owns, operates, or finances real estate that produces income. Think of them as giant landlords, but instead of renting out a spare bedroom, they're renting out office buildings, apartments, shopping malls, warehouses, hospitals, even data centers. The cool part: you don't have to buy a building. You simply buy shares of REITs on the stock market, just like buying Apple or Tesla. Why do REITs exist? Because in the 1960s, the US government wanted everyday people, not just wealthy investors, to have access to real estate investments. The one big rule: REITs must pay out at least 90% of their taxable income as dividends. That's why people love them: consistent and often above average dividends. Section 2. How REITs make money. So, how do REITs actually generate income? It's pretty simple. 1. They collect rent. Just like any landlord, REITs get paid by tenants. 2. They lease space. Long-term leases equals steady cash flow. 3. They can finance real estate. Some REITs don't own buildings. Instead, they provide mortgages and earn interest. 4. Property appreciation. If property values rise, the REIT's value often increases. REITs then take all that income, subtract expenses, and pass most of the profits to shareholders as dividends. You get paid without having to manage anything yourself. Section 3. Types of REITs. Now let's talk about the different types of REITs. Not all REITs are the same. In fact, there are many flavors, but here are the main ones you should know. 1. Equity REITs. Most common. These REITs own physical properties. Examples: apartment complexes, shopping malls, hotels. They make money primarily from rent. 2. Mortgage REITs. Instead of owning buildings, they own mortgages or mortgage-backed assets. They make money from interest, not rent. Important: these can be riskier and pay higher dividends. 3. Hybrid REITs. These REITs combine both property ownership and mortgage investing. 4. Specialized REITs. These are the fun ones because they invest in sectors you might not expect. Examples include data center REITs, servers, cloud facilities; cell tower REITs, telecom infrastructure; healthcare REITs, hospitals, nursing homes; industrial REITs, warehouses, Amazon-style fulfillment centers; self-storage REITs, think public storage units; retail REITs, malls and shopping centers; residential REITs, apartments and single-family rentals. Each category behaves differently in the market, which can help with diversification. Section 4. Why REITs are popular with investors. REITs have become extremely popular, especially for people who like passive income. Let's talk about why. 1. High dividend payouts. Because they legally must pay most of their income to investors, many REITs offer steady dividend yields, often higher than the average stock. 2. Liquidity. Unlike owning property directly, you can buy and sell REIT shares instantly. 3. Diversification. Real estate behaves differently than the overall stock market. This can help stabilize your portfolio. 4. Low barrier to entry. You can invest with $10, $50, $100. No need for a down payment or mortgage. 5. Professional management. You're not the landlord. Experts handle maintenance, tenant screening, property taxes, financing. You just collect dividends. Section 5. The risks of REITs. Of course, no investment is perfect. Let's break down the risks, but don't worry, we'll keep it simple. 1. Interest rate sensitivity. When interest rates rise, borrowing becomes more expensive and REIT prices may fall. 2. Tenant risk. If companies leave office buildings or malls close down, rental income goes down. 3. Sector risk. Different REIT sectors perform differently. Retail REITs suffered during e-commerce growth. Office REITs struggled during work-from-home shifts. Data center and industrial REITs boomed with technology and online shopping. 4. Dividend cuts. When the economy slows or rent drops, dividends can be reduced. 5. Market volatility. Just like stocks, REIT prices can go up or down daily. Section 6. How to pick REITs without being a Wall Street analyst. If you're new to REITs, you might wonder, how do I choose the right ones? Here are simple, beginner-friendly tips. Look at the sector. Do you believe that sector has a strong future? Data centers? Healthcare? Industrial warehouses? Check the dividend history. A REIT that consistently pays dividends, even during tough times, is usually more stable. Look at occupancy rates. Higher occupancy equals more rent equals more income. Check the debt levels. Lower debt equals more flexibility. Consider REIT ETFs. If you don't want to pick individual REITs, an ETF gives instant diversification. Section 7. How to start investing in REITs. Alright, so you're ready to dip your toes in. Here's how you can start. Option 1. Buy individual REIT stocks. Just search for them on your brokerage app like you would any stock. Option 2. Buy REIT ETFs. These funds hold multiple REITs and spread the risk out. Option 3. Real estate crowdfunding platforms. Not exactly REITs, but similar for passive income. Start small. Even $20, $50 a month can grow significantly over time. And that's a full breakdown of REITs, what they are, how they work, why investors love them, and how you can get started today without needing a ton of money. If you enjoyed this video, don't forget to like, subscribe, comment below which REIT type interests you most. Thanks for watching, and I'll see you in the next one.